I'm very pleased to welcome everybody here today to the second New York Fed conference on FinTech. The conference was originally scheduled, as I'm sure many of you know, for April 4th of this year, so timed to coincide perfectly with the peak of the pandemic in New York. So we've delayed by a few months and gone virtual. While the delay was unfortunate, by hosting this year's conference virtually, we have an opportunity to reach a bigger audience. In fact, we have more than or nearly 500 people registered for the conference, so many more than we could have hosted in person if we had been all coming into the bank. So with all the events this very long year, I am glad to be able to see at least one small positive impact of the pandemic. Before I begin, I should note that, as always, my comments today reflect my own views and are not the views of the Federal Reserve Bank of New York or the Federal Reserve System. With that, this year's conference touches on many topics of interest to the Federal Reserve: digital currency, fast payments, financial inclusion, machine learning, and artificial intelligence. These are topics that affect nearly everything we do at the New York Fed and in the Federal Reserve, from the services we provide to the financial sector, to our supervision of large financial institutions, nearly all of whom are exploring or adopting FinTech and RegTech applications, to our own use of these techniques in our economic analysis, market surveillance, policy analysis, and other analytical projects. I see from the agenda that there's a panel and several papers on big data and machine learning. I thought it might be of interest for you to learn about some of the initiatives in data science here at the New York Fed. There are many, more than I can cover in some brief introductory remarks, so let me focus on one effort in my own backyard from the Data and Statistics function, which is part of the Research and Statistics group, of which I am the head. The Data and Statistics function provides data and data science services to research and other groups at the New York Fed. When second district banks and other financial institutions file their regulatory reports to the Federal Reserve, the Data and Statistics function is the ingestion point. They take in the reports, analyze the information for accuracy, and provide fit-for-purpose results to end users. Data and Statistics also collects data on behalf of the U.S. Treasury, the Office of Financial Research, or OFR, and other areas of the New York Fed, such as the markets and supervision groups. So how does Data and Statistics use data science to improve what they do? Let me dive in a little to talk about one particular effort around anomaly detection. As I noted, statistics monitors the quality of data submitted by banks for accuracy, largely by identifying anomalies in reported information relative to previous reports from that firm, relative to peer institutions, relative to related items on the same regulatory report, and relative to other factors, such as typical cyclical or seasonal variation in the reported items. The area collects dozens of reports with hundreds, sometimes thousands of individual data items each for a large number of financial institutions. Once the data has been cleaned and deemed fit for purpose, the supervision group then uses the data to identify substantive anomalies that might signal the need for supervisory actions, doing analysis over largely the same large set of information. So the data scientists and statistics are investigating combining these two functions into a single machine learning capability to enhance efficiency and productivity. Our hope is that a single machine learning model can predict thresholds for both detection functions, both data quality as accomplished in statistics and anomalies, substantive anomalies, as currently identified by supervision. Our data scientists are testing a way to leverage the results from an adaptive threshold model for data quality using deep quantile regression for monitoring trends and concentrations across bank peer groups. As an example, supervision and statistics teams could collaborate on identifying quarter-over-quarter thresholds on credit risk-related line items, such as loans secured by real estate, commercial and industrial loans, net charge-offs, by using a single machine learning model. This would improve both the efficiency and effectiveness of statistics efforts to provide clean, accurate data, principally by reducing false positives in the screening process, and reduce duplication of effort between statistics and supervision by allowing supervision analysts to more quickly identify the substantive anomalies that merit closer supervisory review. So that's just one example, a very inside baseball example, because it's something that we do here at the New York Fed that probably isn't widely known out in the public. But it's an example of how we're using big data and machine learning to make what we do better, more efficient, and more accurate. I expect that the experts from academia, industry, and government speaking at this year's conference will provide rich insights into further opportunities and risks from FinTech applications. All of these are, of course, topics of really deep interest to us. I want to end by saying, however, that we as an organization are also deeply committed to a broad mission that encompasses equality and fairness. As the bank's mission statement makes clear, we serve all segments of society. Therefore, while we're interested in understanding the benefits of FinTech, we also want to understand how it impacts those segments of society that are unable to participate in the financial system. In that regard, I'm especially glad that the next panel will discuss the potential for FinTech to benefit the financially excluded. So with that, welcome again to the conference. It promises to be an enriching and interesting 2 days. Thank you very much.